All right, so here we're going to tackle question 10 on the chapter 5 homework for payroll accounting. Wine and Associates has employees with pay schedules that vary based on job classification. Use figure 5.4. For this problem, we will compute the federal income tax withholding for each company using the percentage method in Appendix C. Assume that no pre-tax deductions exist for any employees. So before we get started, 4 things to keep in mind when it comes to the percentage method, from what I understand. First, there's the marital status, whether they are single or married, the number of exemptions, AKA their withholding allowances. The pay frequency also has an effect, along with the pay amount per period. Now, if they were to give you an annual salary, but a different pay frequency, then you would need to divide accordingly. But if they give you the pay frequencies off the bat and the pay amounts for each, then no division is required to make this work. So, let's look at S. Turner. S. Turner is single with 2 exemptions, is paid weekly with the pay amount of $3,300. So the first step is to go to page 403, or you can use figure 5.4, whichever you prefer. And it's going to take you to a table that shows the payroll periods and the amount for one withholding allowance for each of the different pay frequencies. So for example, for weekly. So for the weekly, it's going to be 80.8 because S. Turner is paid weekly. And the number of allowances / exemptions is 2. So if we do $80.80 times 2, you're going to see that the withholding allowances that S. Turner is entitled to is $161.60. So then if we take $3,300, hold on. So if we take $3,300, which is the gross pay for S. Turner, and take away our withholding allowances of 161.6, that is going to equal the taxable income of $3,138.40. So after you find the taxable income of $3,138.40, or whatever it is, the next step is to find the correct table to use. And there's 3 factors: the marital status, the pay frequency, and the taxable income, not the pay amount or the gross pay. So if you look in the book, you should be looking on pages 404 to 405. For S. Turner is single with a taxable income of $3,138.40 and is paid weekly. So if we go in the book on page 404, you're going to see that $3,138.40 is in between $1,692 and $3,164. So what does that mean? That means that's the range that S. Turner's taxable income lies within. So the next step is to take the taxable income of $3,138.4 and subtract by $1,692, as that is the excess over. The excess over here is going to be $1,448.4. So once you figure out what your excess is of $1,448.4 or whatever it is, then you multiply by the variable rate of the income tax withhold. And in the range of $1,692 to $3,164, the variable percentage is 24%, aka 0.24. So if we multiply that, that means we get $347.61.6. If we round this to 2 decimal places for currency's sake, you're going to see that this is $347.62. So all you need to do is round. And also all you need to do is round up. Hold on one second. Let me make sure I did that right. So 31. So let's do that again. 3138.4 minus 1692 multiplied by 24%. Let's see, is that the right percentage? Yes. That's going to equal $347.14 for the variable portion of the income tax withheld. After you figure that out, that's $347.14. Then you're going to add the fixed portion of our income tax withheld, which is equal to $276.54. So altogether, the federal income tax for S. Turner equals to $623.68. Next, we're going to tackle D. McGorry. So D. McGorry is also single. However, you're going to notice a few key differences. D. McGorry has 7 exemptions, is paid monthly, and is paid $16,500 per paycheck. So again, what's the first step? The first step is to go to page 403 or figure 5.4 and figure out, okay, what is the withholding allowance for monthly pay if it was 1? And that is $350 for 1. And if you multiply that times 7, let me show on screen, that's going to equal to $2,450 of withholding allowances for D. McGorry. So then after that is done, you're going to take the $16,500 that D. McGorry is paid on a monthly basis and subtract the withholding allowances of $2,450, and that equals taxable income of $14,050. The next step here is to figure out which table is correct. D. McGorry is single, paid monthly, and the taxable income is $14,050. So if we were to go to table number 4, that covers the monthly pay periods, and we want to look at the single portion as D. McGorry is single. So for $14,050, that lies in between $13,710 and $17,325. So we are going to take $14,050 of taxable income and subtract by $13,710, as we are looking for the excess over that, as that is the minimum income in this range. So our excess is equal to $340. All right. So now that we know what our excess is, we need to see what the variable percentage is for income tax withheld. So in the range of $13,710 to $17,325, the rate that is variable is 32%. So 340 times 32%, that equals to $108.80. Then the last step is to add the fixed portion of the income tax withheld. And in the range of $13,710 to $17,325, the fixed portion of it is $2,728.94. So again, $2,728.94. We're going to add that to the variable portion, and that means overall that our that our federal income tax is going to be $2,800. Oops. Hold on. Let me do something real quick. Okay. So it's going to be $2,800 $837.74. And I apologize if I accidentally clicked on the number too soon on the calculator. You can pause the video and catch that real quick. But again, you want to follow the same formula every time, or the same principles. Now for A. Kennedy. A. Kennedy is married with 6 withholding allowances, is paid daily, and is paid $650 a day. Not gonna lie, that's pretty good for getting paid on a daily. So now for A. Kennedy, we have to look at, for the table, what the withholding allowance amount is for daily payroll. For daily payroll, it's $16.20 if you are getting paid daily. And the number of withholding allowances for A. Kennedy is 6. So 1620 times 6 equals to $97.20 in withholding allowances total for A. Kennedy. So then once you figure out how much the withholding allowances are, you take your gross pay of $650 and subtract the withholding allowances of $97.20, and that equals to $552.80 of taxable income that A. Kennedy earns on a weekly basis as a married man. So now, which table is the correct one to use? Well, we have to look at whether he's single or married. He's married, the pay frequency, which is daily, and the taxable income, which is $552.80. If you go to table number 8 and go over to the married portion, you're going to see that the $552.80 that he's earning in taxable income on a daily basis lies in between $349 and $693.10 on table number 8 for the married people on page 405. So with that in mind, what we need to do is take the $552.80 on taxable income and subtract by $349 to figure out what our excess is. The excess that we get is going to be $203.80. Once we figure out the excess, we look at the variable federal tax rate, which is 22% if you're going between $349 and $693.10. So $203.80 multiplied by 22%, that is going to equal to approximately $44.84 in the variable portion of the federal tax withheld. So if you round up that 6, that 3 is going to turn into a 4. So if we do 44.84 to round up, then the final step is the fixed portion of the federal tax withheld. And in the range of $349 to $693.10 for a married person that is paid daily, the fixed portion is $34.94. So if we add that at the end, what you're going to see is that the federal tax withheld for A. Kennedy, the federal income tax, is $79.78. And finally, we have R. Thomas. R. Thomas is married with 8 withholding allowances / exemptions, is paid annually, which means he's paid once a year, and he's paid $120,000. I hope that's enough to cover all the bills if you're waiting a year to get paid. Just saying. Anyways, so again, what do we see here? We see that R. Thomas is paid annually. So if we go to page 403, you will see that the amounts for withholding allowances annually is $4,200. And the amount of withholdings that R. Thomas has is 8. So 4,200 times 8, that equals to 33,600 in withholding allowances for R. Thomas in 1 year. The next step is to take that 33,600 of withholding allowances and take it away from his annual salary of 120,000, and that's going to give you his taxable income of 86,400. So now we know what our taxable income is of $86,400. Now the next step is which table is the right one to choose. Well, R. Thomas is married, he's paid annually, and his taxable income is 86,400. So the correct table is table number 7 because he's being paid annually. And the portion of the table is going to be the married portion as R. Thomas is married. Now, which bracket is the correct one to use? It depends on the taxable income. And in this case, it's 86,400. So if we go to page 405, you will see that 86,400 is in between the range of 31,200 and 90,750. So that means 86,400 minus the minimum of that range of 31,200. That gives us an excess of $55,200. The next question is, what is the variable percentage for the federal tax, for the income tax to withhold? Well, in the range of 31,200 to 90,750, you will see that the percentage that's variable is 12%. So if we multiply 55,200, which is the excess, by 12%, you will see that the variable portion is going to be $6,624. And then the last step is to add the fixed portion of the income taxes. So for the fixed portion, if we're looking between 31,200 and 90,750 for somebody that is married and is paid annually, you will see that the fixed portion is $1,940. So if we add $1,940 to this, you will see that the federal income tax for R. Thomas is $8,564. So I'm just going to check my work and make sure this is correct. So let's see if I got it right. Yes. Okay, cool. Awesome. Okay, so I hope you enjoyed this video for classmates that are interested in seeing a quick little video for question 10 on the homework. So what are the following principles? What are the steps as was discussed in class today? So the first thing you got to ask is, okay, marital status. Are they single or married? How many withholding allowances? What's the pay frequency? And then the pay amount. Once you've established those 4 criteria, you then go to page 403 and see, okay, what is the withholding allowance amount for the appropriate pay frequency? And then how many withholding allowances you have. So then you would take your weekly withholding allowances or whatever pay frequency and multiply by the number of allowances, all right? Then you would take that away from the gross pay, the pay amount, to get your taxable income. Then after you find your taxable income is where things get complicated. Then you got to find the right table. And there's 3 things you got to look for in the table. Number 1 is, are they single or married? That's one factor. What's the pay frequency? And then what's the taxable income, not the gross pay, because the withholdings are going to reduce their gross pay down to their taxable income. Then once you find your taxable income, you see, okay, what range does this fall under? Okay, that range. Once you find that range, you would take your taxable income and subtract by the minimum of the range that it fits in to get your excess. Then you look for the variable percentage and multiply the excess times the percentage. Then at the end, there's a fixed portion that you add, and that'll tell you what the federal income tax is going to be. So I hope y'all enjoyed this. I'm going to take off. See you.